Hi, everybody. Welcome to Friends Talk Money. I'm Pam Kruger, co-host of Money Track on public television and founder of WealthRamp.com.
I'm Richard Eisenberg, a personal finance writer and editor, and formerly the editor of the Money and Work channels for the PBS site for people over 50, nextavenue.org.
And I'm Terry Savage, nationally syndicated personal finance columnist and the author of The Savage Truth on Money.
We're three friends who like to talk money and all the issues that come with it.
On this podcast, we're trying to help you understand your personal finances
to get you and your retirement on the right path for true financial peace of mind.
Well, hi, everybody. Well, yes, we here at Friends Talk Money know that there's still some time before tax day. It actually falls on Tuesday, April 18th in 2023, but there is not much time left to make some smart tax moves that can lower your 2022 tax bill. So we're here with some suggestions about 2022 income and deductions, taxes in your investments, taxes in your 401ks and IRAs, taxes in your charitable contributions, and taxes and gifts to your children and grandchildren. It's a lot. Before we get started, Terry and Pam, do you have any overall thoughts when it comes to taxes and 2022? It's been quite a year. Terry?
Well, it has been quite a year, both for the stock market and a lot of other things, your life and your job. And the one thing I would say is you plan ahead to next year, not so much something you can do now, except get organized about your taxes. Next, we've all learned a lesson. You're going to have to file electronically, and you should be prepared to put in direct deposit information in case you're getting a refund. So make sure your bank accounts are up to date and so forth. This is a year to plan ahead in a lot of ways. I know you may still have problems outstanding with the IRS from 2020 and 2021 returns. I've talked to them. They're working on them. They've hired more people. Here we go again.
And beyond taxes, just like you said, Terry, Richard, we're focused on year-end smart tax moves you can make right now. And there are a few, and we're going to go through those. But it's also the time of year where someone smart just said to me, when I get together with my family and I have them all over my house, I might want to use the excuse that I've got to go get some work done in my study here. It's the time to sit down. It really is. Year end is a great time to look at everything, big picture, and make adjustments. Look at what you're doing that worked in the past. Look at what you're about to do. Get a good sense of your net worth. Get a good sense of where you stand. And I think year end is just a natural time to pause and just assess and review everything, taxes included. And I think you'll have a better perspective going into the new year, doing it at the year end.
All right, so let's get started. One thing I'll mention is just looking big picture. And, we've just had these big elections. I would think that the recent elections mean that we're unlikely to see any kind of major tax legislation this year, probably not even next year. So let's jump right in and talk about what you can do before year end to lower your 2022 tax bill based on your income and tax deductible expenses. So the first thing you're going to want to think about is what tax bracket will you be in this year, and what tax bracket do you think you're going to be in next year? If you think you're going to be in a higher bracket next year, you may want to try to push 2023 income into 2022 and postpone some tax deductible expenses until next year when they'll be more valuable to you. And then the flip side, if you think you're going to be in a lower tax bracket next year, you want to do the opposite. You want to try to push 2022 income into 2023 and grab all the tax deductible expenses you can this year when they're going to be worth more to you. One thing you should keep in mind, because inflation's been so high, the IRS recently announced a 7% inflation adjustment to 2023 income tax threshold. So what that means is if your income will be the same next year as it is this year, you may be in a lower tax bracket in 2023. Now, if you'll be looking for tax deductible expenses for 2022, the key is figuring out whether you'll have enough of them to itemize on your 2022 tax return. There's a good chance you won't, because the standard deduction is now so high, it was raised a few years ago, you can't itemize unless those expenses would be less than the standard deduction, which is $12,900 for singles, $25,900 for married couples filing jointly. But if you will be able to itemize, you could look into things like prepaying 2023 property taxes, state and local income taxes. but you're limited to a total deduction of $10,000 for those state and local taxes. You might also look into paying unreimbursed medical expenses before year's end to try to get a tax deduction for those, but they're only deductible once they exceed 7.5% of your income. So again, most people won't be able to do it. Now, there are some tax breaks you may want to try to claim for 2022 where it does not matter whether you're going to itemize or you're not. And these are tax credits. I'll mention a couple. One is the tax credit for buying a new electric vehicle. There's a credit that ranges between $2,500 and $7,500, depending on the battery. But to claim the credit, the vehicle's final assembly must have been in North America, so that rules out a lot of cars and SUVs, and the manufacturer cannot have sold more vehicles than the number Congress specified, so that eliminates some more. But I checked, and right now, there are electric vehicles that do qualify, including ones from Audi, BMW, Chrysler, Ford, Jeep, Lincoln, Mercedes, Nissan, Rivian, and Volvo. So there are some out there. One of the tax credit I want to mention is what's called the credit for college or graduate school. It's the lifetime learning tax credit. It's up to $2,000. To qualify, your income must be below $90,000 if you're single or below $180,000 if you're married. But if you qualify, it's a great tax credit. So I'll stop there and turn to Terry and Pam to talk a little bit about investing and taxes for 2022. Terry, do you want to start?
Well, let me say one other thing, and this may not apply to you, but it might apply to your younger children or to maybe the checkout cashier at the grocery store where you shop. There's the child tax credit, which was expanded greatly this year. And that means children under 7 qualify for $3,600 a year in a refundable credit that was part of the, I think it was the Build Back Better Act. So there's a link to, we're going to put a link in the show notes. All the details of the child tax credit are in a column I posted earlier this year. But if you know someone who is lower to middle income and has children under the age of 17, they might qualify for the child tax credit. One more thing, Richard, that you mentioned that I wanted to mention. You talked about the fact that the IRS has announced that it's changing the tax brackets this year to protect you from inflation, putting you into a higher tax bracket. When we were talking, Richard, you gave me a great example, which I don't know if you have it there, but I think it's a shocking number. Do you have those figures, Richard? I have.
Why don't you?
Yeah. Okay. So suppose you're married and your income is going to be $85,000 this year. That puts you in the 22% tax bracket. But $85,000 next year, you're only in the 12% tax bracket. So yes, it really could save you money, the fact that the IRS has changed the tax bracket. So if you're searching your tax bracket, don't go by the 2022 numbers will apply to this year's income, but next year, the new expanded brackets will apply to 2023 income.
I guess that's the only good thing we can say about inflation, right?
Exactly. They did it.
Exactly.
Pam, you have any thoughts here? Because I want to talk about something that really applies to investments.
Yeah, I think that, the easiest way to lower your tax bill and also at the same time really set yourself up for success in retirement is this is the time to really stop and say, have I truly maxed out all my contributions to my retirement plans? And if you're over 50, you've got the catch-up provisions, $6,500 to catch up, but max out those plans. And next year, know that the contribution limits are going to be higher, which is great news for 2023. But right now, get that money working for you and get max out in every way you can before the end of the year.
When you say catch-up contributions, just in case our audience doesn't know, that means there's an extra amount that you're allowed to put into retirement accounts if you're over 50 compared to everybody else, right?
Yeah, that's above and beyond. And what's great is that next year those are going to jump up, pretty significantly. But I don't want to tease that and get people thinking next year. I want to think about right now. What can you do right now? If you're over 50, the catch-up provisions is money that you can put into your IRAs, into your 401ks. That's over and above the normal amount. And all advisors in my network and everyone that I talk to, CPAs, feel that is great advice before the end of the year.
Yeah, you can go into for your HR department and say, I want to take more out in December for my paycheck, because I notice I'm about $1,200 short, especially of getting the match where they match you 50 cents on the dollar. So walk into the HR department. Yeah, that means you won't have Christmas money in your pocket, but it means the money will grow for you over the long run.
Yeah, Terry,
Yeah.
just let me echo on to that, a lot of people forget about, taking full advantage of the match, which could be as much as 6% of your income. So, if you do nothing else, give the gift for yourself by the end of the year to really, take full advantage of that matching, get that money working for you.
I want to talk a little bit, Richard, about year-end things. All the money in your 401k is going to grow and it's going to come out taxed as ordinary income whenever you take it out in retirement. I want to talk to you about the fact that we've had a very volatile stock market this year, and you may own stocks that you've owned for a couple of years where you might want to make some tax moves, and you should be aware. Let me just give you the 101 on this. If you've held stocks or other assets, the gains you have when you sell them are called capital gains. Now you can have short-term capital gains if you have a profit and you sell before holding for 1 year. Or short-term capital loss for that matter. But if you hold your stocks for more than a year, we'll talk specifically about stocks, it's considered a long-term capital gain if you sell at a profit. And a lot of people don't realize this. The tax rates on long-term capital gains are extraordinarily valuable. I want to tell you that if your income is less, I'm going to give you the rough numbers, not the down to the penny. But if your income is less than 42,000 roughly on a joint return, or about under 84,000 on a married return, you don't pay any capital gains taxes. You sell your stock at a profit. And I know you still have some profits because you've been buying stocks a long time. But if you're in the middle, if you're single, and the long-term capital gains tax rate of 15% applies if your 2022 income is a little over 41,000, but less than $500,000. So roughly. So what you want to do is make sure that if you've held stocks for longer than a year and you're going to take a profit, you're aware that you get this tax break. Now there's another tax break. If you sell some stocks at a profit, but you also hold other stocks at a loss, you could sell those and then offset the capital gains with the capital losses. Short-term and short-term, long-term and long-term. And let's say, what was a bad year, and you still have a net loss. You can deduct, and boy, they haven't changed this for years, they ought to adjust this, but you can deduct $3,000 of losses against ordinary income. That's really a great tax deduction that if you really think you're going to be moving into a higher bracket this year, maybe you want to take a loss. This is, again, everything outside your IRA. And by the way, if you had a lot of losses, you can carry forward those losses for future years, every year deducting $3,000 against ordinary income. Think about that when you make your year-end moves. Now, I want to talk, Richard, give me just one more minute.
Okay.
I want to talk about something that is just human nature. Okay, I'm gonna take my profit or take my losses, and I'm gonna sell my, I don't like Tesla stock anymore. I don't know about Elon, but I'm gonna sell it because I still have a profit. Maybe I'll take a loss because Amazon's down since I bought it. So you say, oh great, I did a great offset, but I really like Amazon. I'm gonna buy it right back after I use the tax loss. Oh no, you are not gonna do that. That is called a wash sale. And you are not allowed to buy back that stock that you sold at a loss for 30 days, and not just 30 days afterward. Don't be
30 days before too.
Don't be smarty and double up. I'll buy some now and then I'll sell some. It's 30 days either side of the sale you make to establish that tax loss. If you buy that same or substantially identical security, we'll talk about that, within 30 days either side, they'll disallow your loss. It's called a wash sale. Now, what would you do? Well, maybe you'd buy a tech ETF, and it's probably got Amazon in it.
Yeah.
Maybe. Then you could do that as a placeholder and then wait 30 days. And by the way, that goes over year end. So if you say it's December 15th, you'd have to wait till January 15th for that 30-day period. So again, this is stuff that's inside your that's not inside your 401k or your IRA. It's your own stocks. Gains and losses matter, offset them, carry the losses forward if you have extra losses, but don't think about buying them back before 30 days.
Yep.
Okay.
And let me pile on to that just for a quick second, that, for non-qualified accounts, for taxable accounts, looking to lock in those losses right now, especially not just on individual stocks, but on mutual funds and ETFs. The reason I love ETFs for this is they're ideal for what's called tax loss harvesting, because there are so many lookalike funds that look just like they're tracking the same indexes, the same indices. So you can look for substitute positions to swap out of and switch to, and still stay within the same asset class, but without violating that all important wash sale rule.
But be careful, if an ETF is tracking the same index, it's substantially similar, and that won't qualify. So you just don't play games.
Enough variation where you can find something that's enough in your asset class, in your lane, and that's why I love ETFs for this, for tax loss harvesting.
This is also the time of the year that some mutual funds have what are called capital gains distributions, where suddenly the investors who own those funds find out that the fund sold some of their shares, and people are then going to owe taxes on those distributions. Even though it's been a terrible year for the stock market overall, these could have been gains based on many, many years. So I wonder, Terry, is there anything you want people to know about those distributions? And maybe that might affect whether they want to buy or sell a mutual fund before that distribution.
Exactly. So here's the point. Your fund has been buying and selling stocks throughout the year. The share price of your mutual fund is down substantially. You hate it. You're really angry. You're down. But they are going to distribute capital gains and maybe even some dividends that they haven't offset to you. And you could find out about that, what that date is of that distribution, by looking at the mutual funds website. Actually, Morningstar, I think, has a list of the dates on which distributions will be made. They'll be made, either they've already been made by the time you see this, or they will be made in December. So when the date they make the distribution, they'll reduce the fund share price by the amount of the distribution, 42 cents a share or $1.19, whatever it is. So don't buy please don't buy the fund shares the week before they issue a distribution, because then you're going to get taxed on the distribution, and the share price will go down to offset that. Buy new mutual funds after they've made, if they're going to make them, they don't all, buy them after they've made their distributions for the year.
Great. One thing I just wanted to add to what Pam was saying before about retirement accounts. Some of our audience may have money or think about putting money into IRAs. The IRA rules are a little bit different than retirement plans like 401ks. You're allowed to put up to $6,000 in an IRA for 2022, or $7,000 if you're 50 or older, but you have until April 2023 to put the money in to fund that IRA, and it still counts for 2022 as long as you open the account sometime in 2022 or before. So my advice there is, if you want to have an IRA, but you don't even have the money right now, but you will, make sure you open it now so that you'll have some time early next year to start funding it.
Such a great point. Get the account open now. Yeah.
One more thing, which I just thought of. Look, you have an RMD, required minimum distribution. It was based on last year's year-end statement from all of your mutual funds, or the one that your IRA is in. Do not wait till December 19th to call Fidelity, Schwab, wherever your account is, and say, please send me my RMD. Come on, don't game that. Just take the RMD right now before they get so busy with all the people doing year-end stuff. Make sure there's a penalty for not taking your RMD.
But that's only for people of a certain age, right, Terry? That's not for everybody.
Yes, if you're over 72, you know who you are. I know a lot of are.
Hey, and the good news is next year that's going to hopefully with legislation that's going to increase.
They're talking about legislation. Too late for those who are already taking it up. Okay.
Terry, I want to ask you about something else that relates to IRAs and taxes, and that's the idea of converting a traditional IRA into a Roth IRA before the end of the year. Some financial advisors recommend doing that because they say you're going to owe income taxes on your Roth conversion, and a lot of stocks have lost value this year, so the taxes that you would owe on that Roth conversion would be less than if the stocks had higher values. It's a little complicated, but can you talk about that?
Okay. You know, the advantage of a Roth IRA is that from then on, all the time the conversion on, all the gains come out tax-free. on your Roth IRA. So you think about it and you think, gee, you don't have to convert all your IRAs, but just let's say you have one in it. Earlier in this year, before the craziness of this year, that account was worth $82,000. And you were balanced between stocks and bonds, and they both had a pretty horrible year. And so now that account's worth only $63,000. Well, if you had converted that account last year, you'd pay taxes. You have to pay taxes on the whole thing, and you should have money outside the IRA to pay the taxes. So it would have been a big tax burden. Now you look at it and say, gee, last statement's only worth $63,000. This would be a good time to convert because I'll pay less in taxes. You'd have to think about that and balance it up. And I want to give you one warning. Assuming you're already on Medicare and you're paying Part B premiums, because that amount is added on top of whatever your other retirement earnings are and so forth. That could push you into a higher tax bracket, and it could also make your Medicare Part B premium increase. It's called IRMA. So that means that you would pay more for Medicare for the next year or probably 2 years till they look back and say, oh, that was a one-time thing, or you appeal it. But you want to think about all the tax considerations. Number one, do you have money outside your account? Number two, you're going to add all the amount of the conversion onto your ordinary income. Will that push you into a tax bracket, not only higher income taxes, but impact your Medicare Part B premiums? But other than that, when stock prices are down, you always must convert when the market's exactly at the bottom. That's the best time to convert. You tell me when.
Okay.
Tax
Well,
bill.
let's finish up talking about taxes and gifts to family members and gifts to charity. So if you want to make a gift to a child or a grandchild, you're allowed to give up to $16,000 a person this year without running into any gift taxes, and couples can give up to $32,000 to as many people as they want without running into the gift taxes. Now, parents and grandparents might want to consider putting money into a 529 college savings plan for their child or their grandchild. In more than 30 states, if you put money into a 529, you'll be able to use that contribution to lower your state taxes for 2022. So this might be a good time to put some money into that. If you want to make a charitable contribution and you're close to the standard deduction threshold, so you're not sure if you're going to itemize or not, you might do what tax advisors like to call bunching. Terry, can you explain what bunching is, tax bunching for charitable contributions?
Yeah, it's changed a lot because so many people take the standard deduction and aren't itemizing. But if you're going to make a big gift next year and a big gift this year, bunch them this year, you might get to the point where it's worthwhile to itemize your deductions. So that used to work really well with real estate taxes and everything else, but the limitations are so that very few people, relatively speaking, those are deducting charitable contributions. But I want to make one other point, Richard, something called the qualified charitable distribution. Now, you can have your IRA custodian make a direct gift to a qualified 501c3 charity out of your IRA. It doesn't go into your hands, but they may actually send a check to you to the American that you've designated American Cancer Society for you to pass on, or whatever else it is. And that, if you're over 72, can count against your required minimum distribution. So let's just say your RMD this year was $65,000. And you're really planning to give $25,000 anyway as a tax deduction, maybe or maybe not, to a bunch of charities. Ask your IRA custodian to make that gift directly to the charity, and you've reduced the amount of your RMD. It's a really interesting thing that many people overlook.
Smart. Yeah.
Pam, I wonder if you have any final tips about maybe meeting with a financial advisor or maybe your accountant or maybe both for year-end tax planning before you make any of these kinds of moves.
Yes. In fact, I also think that this episode that we're doing right now is a great sort of a list of the things to check off that you can do. So we're going to have this in the show notes, so you don't have to worry. We'll pull these out and harvest them. So just to kind of go back to the beginning of my first piece of advice at the top about using this end of year to do all these things, to look at all of these things, whether it's, how to give to charity smartly, maxing out all of your retirement accounts as best you can, Also, one other is zeroing out if you have a flexible spending plan at work that requires you to spend it before the end of the year, look at the possibilities between now and December 31st to really, zero out that flexible savings account if you can. And now let me give you a little advice. Oh yeah, and then the Roth conversion. So we'll have this in the show notes, but let me give you a little bit of advice about getting advice, okay? You might be in a hurry. You might feel like, oh, I'm panicked. I'm listening to Terry and Richard's advice and I want to take these actions right now. I just want to suggest, look at this list of things you can do and don't stress out. If you don't know how to do everything, if you don't know how to combine and coordinate with your investment strategy and your planning, because these have to be done holistically. So take your time and find the right advisor who is fee only and is fiduciary, who's really only going to work for you. And those advisors have tax experience and tax expertise as well, but don't rush it. Don't feel like you're in a panic to find advice. Let's make sure it's the right advice.
That's a great tip. And I would say a lot of our audience has tax advisors, people who help them prepare their taxes every year. This would be a good time to sit down with them or have a Zoom with them and just say, any advice for me about what do you think I ought to do, or I'm thinking about doing this, what do you think? Just to get a second opinion might be helpful. And if it's okay, I'd like to just throw in a little inside baseball. It's not baseball season, but I'm going to do it anyway. When we were researching this episode, I was looking into what are the tax brackets, and I ran into this very strange thing, which is I went to the IRS website because they ought to know, and to look to see what they said. And it turns out what was on the IRS website for what the tax brackets are for capital gains was wrong. It was for 2021, but it ought to be for 2022, or at least it should say it's for 2021, and it should also say what it would be for 2022. And they said it was updated in October. So I emailed the IRS and they said, oh, we have to update that. So my advice to our audience is if you're going to go to the IRS site for information, fine, but double check it somewhere else that you believe is reputable, because you can't be sure that what you see is always right.
Richard, you were so good at that. We have to put the link up. Richard and I went back and forth on this. I said, no, Richard, I'm looking here and it says this. He said, no, that's last year's. I'm going to call the IRS. Well, we're going to put a link up to not only the tax brackets for the capital gains, but you'll also find, we're going to put a link up to the tax brackets themselves, income tax brackets for next year. We're going to get all that in the show notes for sure. I'm going to write a column. Richard, you writing a column on this?
I probably will for Next Avenue. Yeah.
Yeah, absolutely. And I'll write it for my syndicated column. So we will also put links to our columns, and we're going to get this up as soon as possible. Right, Pam? You're in charge of that part. Okay.
Well, we at Friends Talk Money are always on your side, and there's a lot to think about right now. I know you're thinking about the holidays and relaxing, but you ought to spend a little bit of time thinking about taxes too. So thanks so much, and we'll see you soon. Bye.
Friends Talk Money is funded in part by a grant from the Investor Protection Trust. The IPT is a nonprofit organization devoted to investor education. Since 1993, the IPT has worked with the states to provide the independent, objective investor education needed by all Americans to make informed investment decisions. Visit investorprotection.org. We also receive support from the North American Securities Administrators Association, known as NASA. It's the oldest international investor protection organization. NASA's members include state and provincial securities regulators from the U.S., Canada, and Mexico who serve on the front lines of investor protection. Recognizing that education and awareness are powerful tools in the fight against investment fraud, NASA is pleased to sponsor Friends Talk Money. Here are 3 important tips to help you protect your money from fraud. With investing, there are always risks, so be cautious of anybody telling you that a certain investment is guaranteed. You should also proceed with caution if somebody is promising very large investment returns. This is a common red flag for investment fraud. Last and most importantly, be sure you're working with a licensed or registered financial professional. You can check your advisor and make sure they're licensed by visiting brokercheck.finra.org. NASA is your partner in keeping you safe and helping you avoid investment frauds. Visit nasa.org and click on the Investor Education tab to learn more.